good afternoon, folks, and I would like to thank the Chamber for inviting me to participate, on the agenda. I thank John Rollins for some of the comments relative to Citizens. John, as you know, joined Citizens after a number of years as a member of our Board of Governors, and he's just adding enormous capability to the Citizens staff. So I want to thank John for representing us and let you know what a tremendous benefit he has been to the Citizens staff. My objective today, basically what you will see is that I'll be validating what you heard from CFO Atwater today, and that is I understand we have a long way to go, both in the all other perils loss ratio area and in terms of how we're addressing wind and rate adequacy. But it's important to really note just how far we have come. Just a year and a half ago, it was pretty much out of control. We had grown tremendously over a 3 or 4 year period. We had peaked in August of 2012 at 1.5 million policies and exposure, excuse me. I'm hoping I can get this back. There we go. Thank you. We had peaked at 1.5 million policies, and our exposure had peaked at $510 billion. So this first slide really indicates exactly how far we have come in literally less than 21 months, roughly 18 months. We've moved from $510 billion in exposure to today, the number you see on the right is $330 billion in exposure. We're actually sitting at a little less than $320 billion today after the last depopulation. In terms of overall probable maximum loss, and that's the loss that Citizens would incur, in the event of a 1 in 100 storm, in 2011 we were right at $22 billion. Today, excluding LAE, we're down at the $16.2 billion level. And obviously where this is coming from is initially there was a huge focus on PLA depopulation. So today, we have focused significantly, but principally on the PLA area. And I'm commenting on that because, we need to continue the progress we're making in that area, but at the same time, maybe shift a little focus to the commercial lines book of business. But the PML, $16.2 billion. On the bottom, we've come a long way. We peaked at 1.5 million policies, and literally at the end of this week, we will break the $1 million policy barrier. So, and that, of course, following me on the presentation will be Steve Bitar, who will go into the Clearinghouse discussion, and you'll see that really is the next stage. The next, I think, stage in terms of what are we going to be doing next to continue this progress and focus on the detail and continue to move this number downward. So, what does that mean? What it means, basically, I'll focus on probably the most interesting segment of this slide, initially, and that is, what's the concern? The concern is unfunded liabilities in the event of a major storm. So literally 21 months ago, we were sitting on an assessment load on the back of all Floridians of $11.6 billion. That's unfunded liabilities. Those are assessments that would have to be made to both Citizens, insureds, and all Floridians in the event of a 1 in 100 storm. This is how it's progressed. That assessment load dropped from $11.6 billion to $9.5 billion at the end of 2012, to $5.5 billion at the end of 2013, and we fully expect to break the $4 billion mark at the end of 2014. So the assessment load, as you can see, has just reduced significantly over a relatively short period of time. How do we do it? It was done through a number of different vehicles. And I'll move up the chart in explaining basically how we accomplished, how citizens accomplished the task. The first is private risk transfer. Just 2 years ago, we really had very little private risk transfer. And as you can see, it was less than $500 million just in 2011 in terms of private placement. In 2012, there was a huge success driven by Sharon Binnen in concert with Guy Carpenter, Willis, Goldman Sachs. We went into the marketplace and frankly leveraged the largest pre-event bond, cat bond, in history. Not just in Florida, internationally and in history. We placed a $750 million cat bond that frankly set the stage across Florida and internationally for the pricing in the cat bond arena to drop and leverage the pricing that's occurring now in the marketplace between catastrophe bond as a mechanism for alternative risk transfer and private reinsurance. So that was a huge benefit. We also increased our direct risk transfer by $750 million. And as you can see here, we moved up to $1.5 billion in total risk transfer in 2012. We actually upped the ante slightly in 2013 and ended up with $1.85 billion in total risk transfer. The intent in 2014, we're going to the market with Willis and Guy Carpenter next week. We'll be in Bermuda. And as you all know, we're expecting significant reductions in both the direct and in the cat bond marketplace. The reinsurance is far more competitive today than it ever has been. And we're expecting some market movement. Now, what does this mean for us? We intend to spend roughly the same amount of buy, but obviously with a reduced overall exposure, it will have even more dramatic impact on the assessment potential, within Citizens. What this is doing for us, of course, is we're less dependent upon the cat fund than we ever have been. We will only be dependent in 2014 to the tune of $4.4 billion as a cat fund member. That's down from $6.5 billion. And surplus, and let's face it, we're incredibly fortunate. 8 years with no major storm. It's nothing but luck. It will happen. Or the major storm will occur. And here, it's allowed us basically to build surplus. So we've gone from $5.7 billion in surplus in 2011. We will end the year roughly at $6.9 billion in surplus. And we're anticipating next year, without a major event, at $7.7 billion in surplus. The other element, of course, is what we were talking about earlier, and that's depopulation and the impact that depopulation has. And as you can see, almost no depopulation in 2011. Depopulation of $2.9 billion in 2012, 2.9 in 2013. It's obviously a little early to predict in 2014, but as I think everyone has probably read, we're starting out very, very effectively, and that's even pre-Clearinghouse. There's already 246,000 requests for policies that have been approved by OIR. Now, we can't expect the same percentage result that we've had historically, simply because the higher the demand from these carriers, the more duplication you get into, for the better policies. So you can't expect the same result. We used to say a 30% opt-out rate was good news. Now we're saying actually a 60% opt-out rate is a good result. But even if this results in another the 246,000 before the July 1st, even if that results in another 50, 60,000, we're well on our way to the target that we've established this year. And that's a combination, when you take a look at new business, reduction in new business, the impact of the clearinghouse, we think we can get somewhere between 900, 920,000 policies at the end of 2014. So to echo basically CFO Atwater's comments, huge progress. Long way to go, but huge progress. I'd like to move now to a different topic. It's not over for the personal lines account. It's not over for depopulation. We want to continue depopulation. Clearinghouse is clearly the next step. Steve will be talking in detail, but we really expect the Clearinghouse to reduce our new business writings from something like 20,000 new policies a month down to 12,000 new policies a month. That's a reasonable target, we believe. Today, it's still pouring in. We're still looking at between 4,000 and 5,000 policies per week, new business being written, within Citizens. So we're still remain heavily focused on depopulation as a way to get the residential business moved back into the private marketplace. And I'm excited to hear, for you to hear what Steve Bitar is going to be presenting today, because this is an exciting concept. It has the potential, Clearinghouse has the potential of significantly changing the nature of this marketplace and significantly improve the ability to get better coverage and better price for consumers. Excuse me. So let me focus just briefly on next steps, because while we continue to work on the PLA account, the residential account, it's time to at least step back and take a look at the impact that the commercial writings that we have are having on the PML and having on the liability and the potential assessment load. I'm going to break it down into two areas. The first is commercial residential business, and here we're talking anywhere from $200 million TIV towers on the coast, down to $1 million, $2 million property. We only write 17,150 policies, but those policies represent $92 billion out of the $320 billion worth of exposure remaining within Citizens, and that's huge. So you take a look at this and say, well, that's 30% of our total exposure. The PML, out of that $16 billion I mentioned earlier, that represents $4.1 billion of PML. And we literally own the market today. I happened to walk in, by the way, just at the time some young man on the panel was talking about Citizens' predatory pricing. I didn't take offense at that, because that's correct. Particularly, by the way, in the commercial residential arena. It is predatory pricing. So Citizens' market share, there's really only 3 companies that are a major factor in the marketplace, other than Citizens. Those 3 companies represent 40% of the total commercial residential market in the state. Citizens writes 43% of the commercial residential market in the state. So between those 3 companies and Citizens, we write 83% of the total residential market in the state. Now, the concern is that we're writing at grossly inadequate rates. So we're writing anywhere from, on the low end, 20% rate need, all the way up to a lot of the coastal business, 70% rate need. And to the point that this young man was making, no one is going to take out commercial residential business with a 70% rate differential. So it is an issue that we're beginning to focus on and taking a look at what alternatives we have. We are not endorsing anything that would have dramatic market availability issues or significant rate increase issues in the marketplace. Our driver basically, as you'll see through the Clearinghouse, our fundamental driver is let's get this done with as little impact as we can possibly get it done on the constituents, Florida, all Floridians. The next element, of course, is commercial non-residential. Commercial non-residential, now this is really what I would describe as just a simple cheap deductible program. The reason I say that is we only offer, for wind, we really offer a $1 million deductible in the commercial. This is what is called commercial or commercial non-residential. So these are non-residential commercial buildings. Now, we all know there's a pretty darn vibrant market out there for commercial residential, to the point where you'll notice I don't have a market share number, because our market share is very, very minimal in the commercial non-residential arena. Very, very small market share. But so we write 21, almost 22,000 policies. It is $14.7 billion of that $320 billion in exposure. It does represent $1 billion worth of PML, and the rate need is right in that 24–25% area. Now, on the commercial non-residential coastal business, it's very consistent with commercial residential, which is primarily coastal, and it's in the 73.5% area. So we're beginning to look much, much closer at this as an issue and trying to determine ways to reduce that overall exposure. I'm going to get into a final slide on legislation that is being considered at this point, but I want to focus on this slide first. We're always asked, so what could citizens look like? And this has to be redone, frankly, after the March takeout, because we'll have a better feel for really what the underlying business looks like at that point in time. But we think this is a reasonable goal within another 24 months. Now, given that we started at 1.5 million policies in 2012, we think that we can end up with something in that 700,000, 725,000 range for policies. If we're successful in some of our commercial focus, it might be below that 371,000. But I think, as most people know, that coastal account really has been at the 410,000 level for over a decade. So this, actually, the 371 would be a significant improvement. But this is what we think we would look like. And obviously, we're going to be writing some coastal properties that simply would not be acceptable in the private market. Older homes, I say older homes over 50 years old that companies will not write. Older mobile homes, there's really very little market for mobile homes over 25 years old. Sinkhole. Even with the massive improvement in Sinkhole, you saw John's numbers. The loss ratio numbers in Sinkhole are still staggering. So even with the improvement in Sinkhole, it's going to be quite a while before private carriers, really are interested in re-entering, the Sinkhole endorsement, marketplace. And then, of course, the major condos, rental properties, commercial, non-residential. Whoops. Whoop. And there's nothing happening from a legislative standpoint, so I can't get back to it. So let me focus on just, I have a few minutes remaining. Let me focus on some of the discussions that are taking place. We've been involved in discussions with Chairman Nelson, who has been a massive, massive supporter in terms of the progress that we're making. He has been behind us 100% of the way. The caution, of course, being let's be careful that we don't make any adjustments in the market that would interrupt the market availability. And, of course, Chairman Simmons with the Banking Insurance Committee of the Senate. Some of the concepts that are being thrown around, and whether they get legs or not, we don't know. One of them is really extend the Clearinghouse to commercial. It's now residential. It's something we probably couldn't do before January 2016 simply because we need some internal system adjustments, but that's certainly something that we most definitely support. We think it could have an impact on the commercial arena. Include surplus lines for commercial clearinghouse. That's being considered, and legislation being considered. I'm a supporter from this standpoint, and I know this has been a very volatile issue in the state. I haven't been around here that long, only a year and a half. But I will tell you this, that I can name 5 surplus lines carriers, each of which would have more surplus and capacity available to them than the entire capacity of the state of Florida. So to ignore the capacity that, in my opinion, the capacity that commercial, non-admitted and surplus lines carriers with the right controls bring to the table, I think is maybe somewhat short-sighted, because I think there's a real opportunity there, particularly for some of the A-rated national carriers that might want to enter the state. There are discussions going on regarding a possible step-down program. The residential step-down program worked with very, very little market availability issue. By that I mean we went from $1 million to $2 million to $1 million to 900,000, and as you know, between now and 2015, we'll be down to 700,000 maximum coverage A for homes. Why not the same concept in the commercial residential arena? A rating, and the ability basically to A-rate, individually rate homes at a lower level than we are today. Some programs being considered to address commercial, non-residential business. The actuarially sound rate discussion obviously is a very delicate one, because we're saying that if that is to be considered, we have to be very, very conscious, as CFO Atwater indicated, on the economic recovery and the individual impact it would have. And then finally, and I'm going to expand this, the sinkhole managed repair discussion. We're strong supporters of a sinkhole managed repair program. The policy that we have taken at Citizens is repair it. When you pay cash to an attorney managing litigation for sinkhole, when you pay cash, when you write them a check, less than 20% of the homes get repaired. Less than 20%. That means there's an economic impact on the neighborhood that is just, significant, because you have abandoned homes, you have people moving away, etc. So our concept is we'll repair the home. In fact, Chairman Gardner sent out a release just, I believe, 2 weeks ago that basically did something unprecedented. It basically offered to 1,300 sinkhole litigants the opportunity basically to repair your home today. We will not take any rights away from a legal standpoint. You will still have the same rights that you had before we fixed the home. And that includes, by the way, the right to sue for subsequent damage, structural damage associated, with the property. And the concept here is simple. Let's not keep these people in harm's way while we're waiting for 2 or 3 years going through litigation to fix these homes. Let's fix the homes. Let's make sure that we don't have another situation where we have a home that disappears into the ground and where we have personal harm. So our concept is we'll spend the money to fix the home. Part of that policy also is we'll actually pay more than policy limits if the attorney allows us to fix the home. One of the issues we face is this. We sent that offer out to 1,300 individuals with a right to repair issue in litigation. We got 5 responses back. Why is that? Because the attorneys can't find a way to collect their share. And frankly, that puts the litigants in harm's way. That is the bottom line, in harm's way. So we're very aggressively pursuing a litigation strategy that let's get these homes fixed. A sinkhole managed repair program that Senator Simpson, has raised, we support it wholeheartedly. It will create mandatory sinkhole managed repair. Next step to address the John Rowland's issue that he raised is we need a water mitigation managed repair program to really address the same issues in the water damage arena, and that's pay for the loss, and get it done quickly, get it done effectively. Several carriers, today, People's Trust, Heritage, Florida Peninsula, are actually utilizing the language that's available today, the right to repair language in the contract to really put together a voluntary managed repair program. Our next step after sinkhole managed repair will really to focus on the water damage arena and really put together a managed repair program for water damage. With that, folks, that's my story, and I appreciate you listening.